Hey everyone, welcome to Perspicium. Today we'll talk about something very interesting. What if I told you that you could boost your returns, cut your drawdowns in half, and build a portfolio that's not only stronger, but smarter, all without picking better stocks, timing the market, or finding the next hot ETF? Most investors think that the only way to outperform is to take on more risk. But what if the real edge came from how you combine your assets, not which ones you pick? It's called return stacking, and in this video, I'll show you exactly how the pros do it, using leverage right way and three overlooked assets you probably never considered. And here's the twist, you don't need to pick one asset class over another. With return stacking, you can hold multiple uncorrelated strategies at the same time, stacking them using tools like futures or margin so your portfolio works harder without ballooning the risk. Return stacking is the art of combining multiple uncorrelated return streams into a single portfolio. You do it efficiently using tools like margin, ETFs, or futures. But the goal isn't to just boost returns, it's to make every unit of risk work harder. Instead of choosing between stocks or bonds, trend or value, growth or dividend, return stacking lets you hold them all. Think of it like adding an engine to a plane. You're not flying faster for the thrill, you're extending the range, improving the stability, and if one engine fails, the other one keeps you in the air. You're not replacing your holdings, you're upgrading them. Here's where most investors get it wrong. They think they're diversified because they hold 30 stocks. Not really. If they're all in the same asset class, or even worse, in the same sector, you're still exposed to the same systematic risk if your portfolio is built out of only stocks. True diversification means combining multiple assets that behave differently across regimes, like stocks, bonds, gold, Bitcoin. Let me show you an example. A portfolio of just S&P 500 is efficient but volatile. Gold has a high expected value but bad average drawdown duration. TLT, it's safe but inefficient. Now imagine stacking all these on top of each other. You're not hedging, you're multiplying your edge. And here's the catch. Assets like bond or precious metals may have lower raw returns, but if they have stable Sharpe ratios, leverage can help you there. You can scale them without taking on disproportionate risk. That's the core of return stacking, allocating capital across multiple high Sharpe ideas at the same time, using smart leverage to keep portfolio balanced. You can test and experiment with all of these live on Perspicium. You can check out correlation matrices, portfolio beta exposure, implied and realized volatility, and performance metrics. And if you're wondering how much leverage is too much, check out our deep dive on safe leverage in the last video. Now let's talk about how to actually build return stack portfolios. For a return stack portfolio, you need two things. First one, uncorrelated assets. Second one, efficient access to underlying and leverage. Let's start with the first one. Find uncorrelated assets. You can search online, or if you have your own thesis, you can go to Perspicium and click on beta and market risk. There, given two assets, it will compute the beta, realized correlation, drawdown duration, percentage drawdowns, rolling Sharpe, and realized volatility. For the second part, finding efficient access to the underlying and leverage, there are multiple things you can do. First one being ETFs. They are simple and liquid, but leveraged ETFs introduce volatility drag. Volatility drag is a must know for everyone who plans or invests in leveraged ETFs, and I plan on making a standalone video on volatility drag. If you're interested, stay tuned and subscribe. The second one is features and perpetuals, especially in crypto. This is often a cleaner way of leverage and very capital efficient. The last one being options. They might require a bit of skill, but if you master that, the asymmetry of return and risk dynamics are really worth it. So let's go over an example. The portfolio I showed earlier, the stacked one, is actually 60% S&P, 20% TLT, long-term bonds, and 20% gold. To evaluate how much better was this stacked portfolio was, I'm going to go over the drawdown durations and Sharpe ratios. As you can see here, even though our portfolio performs similarly to S&P 500, it does not suffer from deep drawdowns. And unlike gold, it does not go on long consolidation ranges where you don't see a new all-time high for multiple years. And here's our second metric, Sharpe ratio. As you can see, the stacked portfolio has the highest Sharpe out of all of them, beating S&P 500, Nasdaq, gold, and TLT. Even though simple, this is a very efficient portfolio, and you can lever this up without the risk of getting liquidated. Since the assets are uncorrelated, even though one dips, other one usually stays stable or rises. The portfolio I showed you was 100%. What I mean by that is if you have $1, you can have $1 worth of market exposure, but you don't have to stop there. As I said, these assets have very low correlation, so you can go 1.5 or even 2x leverage without risk getting liquidated. And the model portfolio was very simple, only consisting of gold, bonds, and S&P. But you don't have to stop there. You can add volatility, crypto, real estate, and even some arbitrage plays. So before we move on, I want to mention something. If you find a strategy or an asset with high Sharpe but low return, don't ignore it. Leverage can scale it. Sharpe ratios don't change with leverage. Bonds and precious metals, despite modest returns, are powerful stacking ingredients. Let's talk about some of the risks and misconceptions. Here's what many investors get wrong about return stacking. It's not just about adding more bets, and it's not just about adding more leverage. If your portfolio is S&P, Nasdaq, and Tesla, that's not a stack, that's triple tech. They move together, they rise together, and they crash together. In drawdowns, they don't protect each other, they amplify your risk. The goal of return stacking is to combine uncorrelated return sources, not pile into the same risk factor. As you can see on this plot, a diversified S&P, TLT, and GLD portfolio was down 20% at the worst days of the 2022 bear market, and it recovered most of its losses by January 2024. While an S&P, Nasdaq, and Tesla portfolio down more than 40% at the worst time, it was still down 10% by January 2024. You want assets that zig and others zag, like stocks and bonds, Bitcoin and gold, factor ETFs and volatility strategies. But here is the real risk. Correlations aren't static. In 2022, people stacked stocks and bonds thinking they were safe. Then inflation hit, Fed tightened, and bonds, the supposed hedge, just dropped like a stock. Even trend following got whiplashed as macro conditions shifted fast. That's called regime shift, and it's one of the biggest threats to static portfolios. That's why return stacking isn't buy and hold strategy. You need to be macro aware, forward looking, and data driven. A few common pitfalls to watch out for are sudden correlation shifts, overlapping exposure, volatility drag in leverage products, and portfolios that look diversified but actually aren't. When done wrong, return stacking can amplify fragility, but when done right, it builds resilience. It's not about adding complexity, it's about intelligent portfolio design. Before we end the video, I want to talk about some stack portfolio ideas and also how you can find optimal weights for your stack portfolio. First one would be DXY, emerging markets and commodities. DXY, US dollar, spikes during global crises, emerging markets rally in risk-on environments, and commodities respond to inflation and supply shocks. These tend to balance each other out and create a more resilient portfolio. A second case study would be uranium and clean energy. Uranium benefits from nuclear resurgence, and clean energy happens to be the latest narrative. And the kicker, these assets often move independently of traditional equities, giving you real diversification. These may not be obvious, but they can be powerful. The best return stacks aren't just list of tickers. They combine macro narrative, structural shift, and regime behavior. But let's say you've identified a good stack. How do you decide how much to allocate on each asset? Simple and powerful approach is to use a portfolio optimizer. On Perspicium, you can target different objectives: max Sharpe, min variance, max entropy. Use a stack of SPY, TLT, and GLD. I'm optimizing for maximum Sharpe ratio, and the results show an efficient allocation that balances return and risk across all assets. With just a few clicks, you can build and optimize your stack in real time. You can add and remove assets as you wish, and you can also change the objective. Return stacking helps you get more for every dollar without chasing risk, and the best part, you can do it for free by yourself. If you find this video helpful, make sure to subscribe and leave a like. It really helps the channel. Thanks for watching, and I'll see you in the next one.